Right, hello everyone. I'm going to try and get through supply and demand in 15 minutes. You'll find these notes in the revision folder, which is linked on your email. It's also in the QR code, and I'll leave some outside the classroom. Okay, most important topic in micro, it's the basis of everything. So let's talk about demand first. You will see that the demand is the amount of a good or service that you're willing. That means that you have enough utility. It gives you utility. Essentially, the utility is greater than the price, and you have the money to buy it. So you have to be able to be willing, you have to want it, and you have to be able to buy it. As the price goes up, the quantity demanded is going to go down. That seems to make sense. We have got extensions and contractions, which we'll talk about in a minute. And we're going to talk about shifts as well. Complement substitutes normal and inferior goods. I'm going to assume that you understand those. If you don't, just refer to those definitions there. Okay, changes to price and movements along the demand curve. Very simply, if the price goes up, the quantity demanded will go down. That's the inverse relationship, and we'll move from that point to that point, which is also known as a contraction. So we've shown a contraction along the demand curve. Here, it's really important to note that this is the input variable, the price changes, which causes the quantity demanded to change. It's really important you get that the right way round. It's not the other way round. That we will talk about in a minute. Right, so non-price determinants. Anything that is not the price is going to move you to a new demand curve. It's going to jump you or shift you to a new demand curve. And this, for example, if we have an increase in incomes, what's going to happen to our demand at every time? So essentially what we're going to do is we're going to add on 5 to every one of these. And you can see myself going from this one to add on at every point. That is what we mean by a shift in demand. And really simply, if we put it in numbers, it kind of makes sense, doesn't it? So every point, we're just going to move out 5. So from 20, we're going to go to, from 0, we're going to go to 5. From 15, we're going to go to 20. From 35 to 40. So you can see that there's a rightward shift outwards. And if I join all those up, I'm going to get a new demand curve, which is going to look like that. I'll call that D1. Okay? And we can look at that demand curve. We can look at it horizontally and see that for every price P, that price P, you have a new increase in the demand from 30 to 35. Okay, so these are why it's called a non-price factor, because price over here has not changed and each individual quantity demanded has. There are a number of reasons why this will happen. Pause the video now, go through them and see what you think. Okay, once you've done them, incomes. If incomes increase for a normal good, you're going to get right, and then for a left. Okay, again, the other way around that way. If the price of a complement rises, you're going to see, therefore, the demand for that complement falls, and therefore the demand for your good is also going to fall, and vice versa. The price of a substitute rises, the demand for your good is going to go up or down on the other way. Population increases, you're going to have an shift right in demand. If it decreases, left. Advertising and branding, if you improve it, it's going to go right, left. Consumer tastes improve, you're going to go right and then left. Okay, so there we go. Just check that you got all of those right. If you didn't, go back to the definitions of those things, which are at the top of this page. Okay, that was quick. Supply. So we've just done basically a week of 6B in about 3 minutes. Supply. Now supply, you can use all the definitions of demand. In demand, we said that it was the amount that consumers are willing and able to buy. We just need to change consumers to firms, and we need to change the amount that you're willing to buy to produce. Change 2 words and you get your supply definition. Law of supply, well, that's now going to be as a positive causal relationship. We said there was a negative one before. This is now positive. Costs are any payments for factors of production. You should know that already. Revenue, of course, is your income that you earn from selling the good, and your profit is just simply your total revenue minus your total cost. That will be useful for us in a minute. Right, okay, pause the video, see if you can do these next two. Okay, now you've done those. Competitive and non-competitive markets. This will now make some more sense to you given you've done theme 3. In a competitive market, we can say that there are many buyers and sellers, and they have low barriers to entry, so we're talking something like perfect competition. So as the price rises, new firms enter the industry, increasing the overall output and competition. Therefore, any given firm cannot control supply. So normally you think of monopolistic or oligopoly markets. We're not talking about those when we're talking about our supply curve. A supply curve relates to a competitive market. In non-competitive markets, there are few or just one seller. They tend to have high barriers to entry, and the firm in the industry cannot control both the price, or can control both the price and the output. New firms will not be able to enter if prices rise. So essentially a monopoly does not have a supply curve. You cannot use supply and demand analysis for a monopoly, and that's where we have to use our cost, revenue and profits diagram and profit maximization to talk about those. Right, firms produce goods and services using factors of production, which we know to be land, labour, capital and entrepreneurship. As firms produce more, obviously their costs rise as they buy more of those factors of production. And if the prices rise, they become more able to supply their good or service because they can now buy their factors of production. As the price rises, profits also rise, and this acts, and we know that profits act as an incentive for an entrepreneur to increase their supply. I want to earn more profit, so I'm going to increase supply, or for new firms to enter. And therefore, we see an increase in the price of a good or service results in firms becoming more willing and able to supply their service, increasing the supply in the market. So there we go. Hopefully that's made more sense now. You've gone back through it, because in 6B that may not have made sense to you. Didn't know all of that. Right, we could construct a supply schedule. If you want to do that, please do that now. And pause. Here we go. That's what it should look like. Explain the effect of a price falling from £35 to £10. Well, our price has fallen that way. Quantity supplied goes down. And we can say two things. They become less able. Their output has gone from 7 to 2. Be careful. If this were in thousands of kilograms, that wouldn't be 7 kilograms, it would be 7,000. Just be careful of the units. They're less able. They can buy less factors of production. They're less willing, so that means that they may have a loss, for example, and they may shut down or leave the industry, or they may just have less output and fire some workers, okay, because it's too expensive. They're not able to keep those. This results in us getting to a summary of all of those things, where we can see extensions and contractions on demand and supply curves. We can see that this is an extension. This is a contraction, and this is an extension as we go up. This is a contraction as we go down. And I'll leave you to fill those in. It's pretty obvious what those are. We then get to non-price factors, shifts in the supply curve, changes to technology. That relates to efficiency. And if you're more efficient, then your output is going to rise, and so supply is going to shift right as a result, pulling prices down. Changes to cost of production. Well, that means that I'm less able. I'm going to have to pay more to produce those goods and services. That's going to shift supply left if my costs of production go up. Indirect taxes and subsidies. Well, taxes, if you put a tax up, then supply is going to be shifted technically. We shifted up. That's going to mean you're going to have less output in the industry, and if subsidies go up, your supply is going to go down, and that's another unit to think about later on. And changes to the number of firms in the industry. Well, if you have more firms, then obviously supply is going to go to the right. And that may happen because of changes to barriers to entry, possibly changes to the level of profits in the industry, pulling more firms in, and therefore resulting in a greater output. Just checking my time to make sure I've got enough time here. Right, good stuff. Okay, that leads us to market equilibrium. We can then put those two things together to see why markets reach an equilibrium. Right. We want to, please, if you want to stop the video here and then plot the curves, you can do, or you can just put them straight on. Right, we've labelled the curves, we found ourselves in equilibrium. Now let's see what happens if we have a price of 5. So I'm going to put that in. If the price is 5 here, I'm going to have excess demand. I've got demand of 12,000, I've got supply of 6,000, I've got an excess demand of 4,000. And I can see that if I go to my chart here, if I go to 5 over here, I can take 12 minus 8 is going to be 4,000, or 12,000 minus 8,000, 4,000. I can also, on the chart, immediately see that this is the equilibrium price because there is 10,000 demand and 10,000 supply. So easy as that. Right. Label the excess supply when the price is 8. Pause the video. You can put that in. And I can obviously do that as well. I can put that line across there. Same thing. I can do it on the diagram here. I've got 6,000 demanded. Just label that in. I've got 14,000 supplied, and therefore 14,000 minus 6,000 gives me 8,000 kilograms of excess supply. Great. Right, now this is a very common type of question on the papers, and it's a trick because you've got thousands here. Firms supply 2,000 kilograms more. You've got to identify the column. People get confused here. You're talking about that column there. Demand's not that first column here isn't very useful. You want to look at this other one, and you're adding 2,000. So actually, you're just going to write 4 there. Once you've done that, you can look to see what the new equilibrium price is. I'll leave you to do that because I'm running out of time. I just wanted to say something about shifts and movements and just try and pull all this together by having a look at what actually happens when you have an increase in demand in a competitive industry. Well, what does happen? Well, at first, the price doesn't change. At first, we get this problem here, which is going to be excess demand. You have a demand of 18,000. The price hasn't changed. The market has not reacted. And so I've got a point here and a point there. In order to solve the problem, the free market invisible hand results in the price rising. Obviously, firms realize, hang on a minute, I'm running out of good. I'm going to try to raise my price. Remember, they are not price setters, they're price takers. But when there is not enough supply in the market, they are then able to see if they can raise price. What you're going to see happening is that you're going to see an extension along the supply curve. New firms enter the industry, existing firms have more profit, they have incentive, they want to supply more, and at the same time you have the demand contraction, there's rationing going on there. So I'm going to use the word incentives over here, I'm going to use the word ration over here, and that then brings us to a new equilibrium where there's 14,000 demanded and 14,000 supplied at a price of 8. We've solved the problem. The same is true for the other one there. And I'm just going to quickly show you, I only have a few seconds left, but what's going to happen, say, if we shift our supply curve out to S1, it's going to result in, at that same price, we're going to have an excess of supply. Just going over here, it probably would be I think it should be that point there. So we've got 8,000 excess supply, and as a result, there's excess in our warehouses. Firms drop their price to try to sell it off, resulting in an extension along the demand curve and a contraction along the supply curve, and our new equilibrium is there. And that's how contractions and